Are you looking to become a better real estate investor? Then hang on, because you're about to experience another episode of the world's most popular real estate podcast, the BiggerPockets Podcast. But before we get to this week's show, I wanted to invite you to become part of our community, BiggerPockets.com, the real estate investing social network. The membership is free, and you'll instantly gain access to networking opportunities, educational content, investor tools, and more. Sign up now and get a free copy of our book, The Ultimate Beginner's Guide to Real Estate Investing, read by hundreds of thousands of budding entrepreneurs. Just click this link right here or just head to BiggerPockets.com. With that, let's get to the show.
This is the BiggerPockets Podcast, show 49.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Stay tuned and be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
What's going on, everybody? This is Josh Dorkin, host of the BiggerPockets Podcast, here with Mr. Brandon Turner, my excellent co-host. What up, Brandon?
What up, Josh? You're not feeling too well today, are you?
I'm bumming, man. I'm totally bumming.
Yeah, you gotta get over that. Come on.
Yeah, well, it's a good thing the interview was recorded another day.
Yes, you're only bumming here during the intro. That's okay, but people can't tell. You're feeling great.
I'm feeling awesome. Things are good. How about you? Things are great?
Things are great. And
I heard there was a fire right next door to one of your rental properties the other night.
There was. On Facebook, somebody says there's a house burning on, a big house burning on this street. And I'm like, hey, that's my brand new triplex. Yeah, and so we sat there for a half an hour trying to figure out if it was ours, and it ended up being the next door neighbor's house burned.
Nice.
So.
Well, which is not nice. It's never nice when somebody's house burns, but it was interesting. I was on the phone with Brandon while this was all going on, and he couldn't manage to figure out how to get the police or fire department on the phone.
Nobody would answer their phone. Apparently, they all go home at 8:00 at night.
That's the power of small town living, right?
There you go, rural.
All right, guys, let's get to today's quick tip. All right. So in some cases, folks, Gmail is being sent to spam. So in our BiggerPockets newsletter, those newsletters in some cases are going to spam for our Gmail users. Not all of them, but for some of them. And please help us to let Google know that we aren't doing anything weird or bad or anything like that. If you go to biggerpockets.com/Gmail, we've got some information that'll help walk you through how to make sure your newsletters and other BiggerPockets mail doesn't show up in the wrong place. Rural.
All
right, guys. So today's show is with the great Amanda Han. And you may not know Amanda Han, but she's going to do wonders for your business, I think.
I agree.
Yeah. So Amanda is a CPA and a real estate investor. And she's a really, really funny and smart lady. The goal of this show is to talk about boring types of things like taxes. However, as we always do, we try and keep it light and entertaining for you. And
I think this was one of the funniest shows we've done.
I actually agree. Yeah. So shocking that a CPA has something to do other than crunch numbers, but this one has a sense of humor. So check it out. Anyway, we're going to cover a lot of really good tax tips, loopholes, deductions, and more to save you a lot of money and help you build wealth even faster with more security. So definitely pay close attention. And really quick before we start the show, this is show 49. And you can find us on the show notes at biggerpockets.com/show49.
And real quickly, I wanted to say this is a interesting episode because it's a CPA coming on. But I wanted to, we encourage everyone to jump into the show notes after the show to ask questions, which I still want to encourage everyone to do. We really want to encourage the conversation. However, this isn't necessarily, I want to encourage people not to go on and ask specific tax tips from Amanda on the show notes page saying, I just bought this thing. I don't know what entity I should have, because she can't tell you any information anyway because she doesn't know your story. So anyway, that's my second quick tip is ask questions, but try not to be too specific because she can't answer specifically.
Yeah, just
anyway.
Ask stuff that would apply to other people. Getting down to the minutia about your own situation. That's when you pay an accountant, guys.
Yes.
You got to do it. I know everybody's trying to, do it as cheap as possible, but
unlike you and I, who took advantage of a few quick
we did indeed
tips during the show.
Yes. So with that, why don't we get to Amanda? Amanda, welcome to the show. Good to have you.
Thank you guys for having me on the show today.
Awesome. Thank you for being here. We are going to talk about tax tips today because everyone knows that's the most fun activity we can talk about, right?
Wait a second. We're talking about tax. This is your show. You got this one, Brent. I'm out of here.
All right, bye, Josh. I'll take over. No, we're gonna keep this light. We're gonna keep this fun today, because this is really, 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 really important for real estate investors.
It is, yeah. I mean, normally, as you guys probably know, we don't do a lot of shows wrapped around topics, but we felt this was so important, and we know how good and savvy Amanda here is, so we figured we'd tweak it up a bit. So let's jump right in. Amanda, tell us a little bit about yourself. We know you're a CPA, but do you also invest in real estate?
I do. In fact, I'm actually a third-generation real estate investor in my family. So when my grandparents, when they immigrated to the U.S., they started with condo investments. So ever since I was a kid, I remember going and helping with make-readies when, tenant turnovers and stuff. And, I love painting and all that kind of good stuff. Nice. So that was my first exposure to real estate. However, I have to say that my family didn't teach me to go into real estate. What they taught me to do was to go to school, get a degree. And I ended up with one of the big four firms, coincidentally in the real estate tax department. So I was doing strategies and taxes for some of the developers and investment partnerships. And it wasn't until I read this little unknown book called Rich Dad Poor Dad. Have you guys heard of it?
Yeah. Maybe we'll just change the name of the show. I mean, geez, man.
So it wasn't until I read that book that I personally, starting to looking at my clients and looking at, wow, the amount of money they're making, the type of wealth they're building, and the small amount of taxes they're paying. That's when I personally started to look into real estate for myself.
Oh, that's awesome. So what's your personal investing strategy? Are you a buy and hold investor? Are you flipping houses while crunching numbers? What do you do? Do taxes while painting rooms?
No, I definitely crunch the numbers. I'm more of a long-term hold investor. Most of my stuff are single families, condos, the ones that I more actively manage and acquire myself. I also have some holdings in apartments as well, but those are more in a passive role with syndicated deals. I would love to be a fix and flipper because I do see the amount of money that my clients make from flipping, but I just don't have the stomach for that.
Yeah. But you do have the stomach for tenants telling you that their toilet's clogged.
Maybe I misspoke. So I do manage managers. I'm not the one actually.
All right,
just smart.
Just making sure. Yeah.
Nice.
Right on.
Do you buy just locally, or do you buy anywhere that there's a good deal?
In fact, I'm from Las Vegas originally. Okay. So most of my investments are in Las Vegas. We do have some out of state, and I do have a few in Southern California as well, which were my recent purchases. So I would say the majority of my investments are actually out of state.
So I'm actually curious about that because I used to live in SoCal about 8 years ago, and everybody was looking at Vegas, but Vegas had the monster bubble. How were you affected by all that? I mean, because there was a tremendous buildup and a tremendous crash.
Mm-hmm. That is a great question. I think that's in line with my investment strategy. Like I said earlier, I'm more of a long-term hold investor, so I always buy for cash flow.
Yeah.
And because of that, the bubble really didn't impact me at all. In fact, when the bubble burst several years ago, that was when I acquired most of my properties. So It worked to my advantage.
Great. And I think that's great advice for anyone listening. The key on investments, having quality investments is knowing when to buy and buying, at the right price. I mean, if you're buying for appreciation, those bubbles and the ups and downs of the market are really going to affect you more. But if you could get in at a price where your rents are pretty solid, and you could take a little bit of a hit on them even, then you're probably going to be pretty good to last through the ups and downs of the markets.
Yeah.
Agreed.
I bought a duplex at the height of the market, my first rental property, and it was at the very height. And I paid like, I don't know, 80, 85, 90,000. Today, the thing's probably worth like 70 or maybe even 60. But I love the fact that it doesn't matter because I bought it with good cash flow. Like it cash flows every month. So people always ask, like, well, people who don't like real estate and don't know real estate, they ask me like, how could you be in that? The market goes up and down so much. Isn't that risky? But when you're doing buy and hold cash flow investing, it's not that risky as long as you're smart about when you buy.
Yeah.
Mm-hmm.
Yeah. Hey, Amanda, I had a quick question. You mentioned something earlier, and we haven't really talked about it. Syndicated deals, and I didn't plan on speaking about this, but since you mentioned it, I'd love it if you could at least kind of fill the listeners in a little bit on what's a syndication. What does that mean? Obviously, not obviously, but for those people listening, this is definitely a higher level topic. So if you're unfamiliar, you might want to take some notes.
Sure. So syndication is commonly known as group investing. We represent clients who do syndications, and a lot of our clients invest in syndicated deals. So generally what that means is, let's say, Josh, you found a great apartment deal and you needed to raise $1 million for down payment. So what you would do is you work with an attorney to put together a offering. And then that offering is presented to, your network of friends, family, outside investors. And so if I was interested in your particular investment, I might put $10,000 or $50,000 into the deal, and I would be, maybe a 5% owner in that particular deal. Typically in syndicated investments, for me as an investor, I'm passive in nature. So I essentially give you the money. You make all the day-to-day decisions of acquisition, management, firing people. And then I just kind of sit back and hopefully get my return, get my cash flow, get my appreciation.
Gotcha. And what are those return? What's I guess the average typical range on return on some kind of syndication deal? Is it similar to say a typical cap rate, or are we looking at something different?
That's a great question. It really depends on the deal itself. Just like when you invest, the cap rate's different from market to market from time to time.
Yeah.
I have my money in 2 different syndicated deals, and I'll share my story with you. One of them is pretty much worthless.
Oh,
so the return is terrible.
Yeah.
I have another one which has been doing great, roughly about 18% return per year.
Okay.
So I was really happy with that one. So it really depends. What I always tell my clients is when you're looking at syndicated deals, the number one most important thing to look at is the syndicator themselves, the team behind the deal, because they are the decision makers.
That's really, really good. So how do you find a good, syndicator then? How do you find somebody who you can trust and that you believe in that's going to give you the 18 and not the 0% return?
Well, the first tip is to just Google their name. Okay. You never know. You meet people at investment clubs all the time, and they'll tell you, I've got this great deal and today's the last day. I always tell my clients, be wary of that, because good deals always come and go, and you don't ever want to jump into something. If you don't know the syndicator team, at least Google their name. So Google Brandon Turner and fraud, for example. They'll show up anything that's, fraudulent related. And then another thing is just to talk with other investors. A lot of the syndicators that are good, they will have deals under their belt. So you can talk to people who've invested with them in the past, and get an idea of, how they've done, what their track record is.
By the way, everyone's going to go Google Brandon Turner fraud now.
Hopefully that doesn't turn anything up or my background check guy didn't do a good job.
Well, it may. Brandon Turner is the name of a famous skateboarder, apparently. And I don't know if he did some shady skateboarding deals and come up. So, yeah.
That's funny. Well, so Amanda, do you need to be an accredited investor to participate in syndication deals, or can anyone do it? And can you explain what an accredited investor is while we're at it?
Yes, that is a great question. That's actually not my expertise. This is a great question for a syndication attorney. In fact, I just took a class from Jean Trowbridge, who's a syndication attorney that teaches for the commercial real estate arena, because there has been a lot of changes. So prior to the Jobs Act, only accredited investors / sophisticated investors, which means, financial planners, CPAs, people who are financially savvy, could invest in syndications. But that's changed now, actually. Syndicators can take on non-accredited, non-sophisticated investors, but there are a lot of restrictions and rules that they need to watch out for. So that's definitely something to run by an attorney before you proceed. It's really important when you're dealing with raising money to protect yourself and make sure you're adhering to the rules.
And I think it's a great point. And I was actually going to say that if you're at all interested in this topic, and I think we are going to cover this topic in more depth in the coming year, definitely make sure you talk to an attorney. Don't go out and just say, hey, I'm trying to raise money and start advertising it and whatnot. Before you do anything, find a good attorney who deals with this kind of stuff and talk to them, find out what's okay and get the ins and outs, because there's a lot of stuff that can get you in trouble if you mess it up.
Yeah, that is very true. Very true.
Cool. Well, definitely interesting. It's cool to know about your background, but you know what? Frankly, we don't really care about your background. We're here to talk about taxes.
I care. Amanda.
I care too. Actually, Amanda is one of our writers on the BiggerPockets blog, and she writes some really, really awesome stuff. If you guys have not yet checked her out, obviously we'll make sure to link to her articles on the show notes at biggerpockets.com/show49. But let's kind of shift and transition to the tax stuff. Are there any important tax changes that investors need to know about for basically 2014 and beyond?
Mm-hmm. Well, definitely. Actually, some of the big changes that impact real estate investors and the general public as a whole actually already took place in 2013. I don't know if you guys remember what you were doing for New Year's Eve last year, but for us as CPAs, we were really hanging on the edge of our seat to look at what was going to happen with the fiscal cliff. So if you guys don't already know, what happened as a result of the fiscal cliff was that Congress passed a new bill. It was called the Taxpayers Relief Act of 2012. Mm-hmm. So part of the relief was, it makes you feel like, hey, the taxes have gone down. We're all saved from this crisis. But one of the major changes that came out from that bill actually related to real estate investors. So if you've heard of Obamacare tax, correct?
What's Obamacare? What
Obamacare.
What is that?
Obamacare or the surtax. So essentially what that is in short is it's a additional 3.8% tax on investment income. And that's important to us as real estate investors because we make rental income for those of us with cash flow rental real estate. Also, when we sell properties, we have potential capital gains that might be subject to this new tax. And also, if any of the listeners today have trustee investments, you generate interest income. That's another one that's potentially subject to this new tax as well. So very important change that came out effective January this year.
I thought the 3.8 was for a very specific target, something like 250K in profits or above. It was pretty narrow, though, wasn't it? It's not just anybody who makes income is paying the 3.8%. Is that correct?
Correct. So this tax is subject to individuals who make total $200,000 per year or more. Or if you're married, $250,000 or more. So that's kind of like a marriage penalty, right? Because if you're single, it's 200, and married, it's only 250.
Nice. I just want to point out really quickly to Brandon, who's listening along with our listeners, that I know a thing or two about this stuff, man.
You do? I know. Did you see me looking impressed when you said that?
I did. I saw your eyeballs pop out of your head.
Wow.
Yeah.
I'm surprised too. I'm very surprised because we teach on this topic quite a bit, and not a lot of people know the rules or have even heard of it.
Yeah.
Wow. Josh, you're not just a good face. You're also a good mind.
Yes. All right. Anyway, no. Okay. So, well, that was definitely a very, very important change. Are there any others that come to mind? Just really quickly.
Another one that's along the same line is another 0.9%, and that's on earned income. And similar threshold, it's people who make 200 or 250 and over. That one more impacts real estate investors who are maybe flipping or wholesaling or doing syndication. Okay, so that's kind of the evil twin sister to the Obamacare tax.
Gotcha. All right. So is there anything other than making less money that we can do to protect ourselves from these changes?
Well, I wouldn't look at it as making less money. It's just more about making the right type of money.
Okay.
You guys know one of the best things of being a real estate investor, especially as a landlord, is deducting depreciation expense is a paper loss.
Yep.
So even though there are all these brand new taxes and they're taking away deductions, depreciation is still a strategy we can use. And in fact, for the most part, with depreciation, not a lot of people. Not all of our clients, at least, are going to be paying this brand new tax anyway, because it's based on net investment income. So it's after mortgage interest, after property taxes, management fees, and all that great stuff.
Okay. Could you actually touch on something real quick, just for those who maybe aren't investors yet and maybe are a little bit newer at this game? Can you kind of explain what depreciation actually is? Like, what do you mean by, that's a great benefit that we have? Because it is, but I want to make sure everybody who doesn't own rental property yet also understands why it's kind of cool.
Sure. So the IRS has a loophole. Basically, what they think is that real estate, just like when you buy a car, the IRS feels like, well, the car is going to go down in value. And so if you bought it for $10,000, you get to deduct part of that per year because it's assumed to be going down in value. And they apply that same theory to real estate. So if you buy a house for $100,000, for example, then the IRS says, well, I think you've owned it for a year. Now it's lower in value. So you get to write off part of that $100,000 purchase price. And that's a huge benefit for real estate investors because, even if you're in a time period where it's appreciating in value, the IRS still allows you to take a write-off, assuming that it's still going down in value. So that's what we refer to as a paper loss. Essentially, you're taking a tax deduction and nothing actually really happened. The value hasn't gone down. You haven't spent additional money on that.
So is that lowering your base? Is that essentially what that does?
Correct. So it lowers your basis so that in the future, when you sell, then you have a lower basis to calculate what your gain is going to be.
Gotcha.
So that means when you sell, though, you're going to end up paying more later on, right? I mean, you got to pay back that depreciation eventually, correct?
Potentially, if you sell at a gain.
Okay.
And there are other strategies, such as a 1031 exchange, where you can defer the gain to the extent that you're going to buy a replacement property. Let's say you're selling a single family, you're buying a duplex, then you could potentially defer the tax on that gain.
Okay. That's cool. So what other important write-offs do investors have? I think probably the most famous is going to be the mortgage write-off, right?
Yeah, the mortgage interest write-off.
Yeah.
One of the things that came out in 2013, in fact, is for primary homeowners. Okay, if your income is over 250,000 single or 300 married, that the IRS is going to start limiting your mortgage interest deduction.
Really?
Now, the key here is
I didn't know that one.
Oh, see,
I got to make more money to worry about it. Yeah, but I don't make enough to worry about that, so it's all good.
So that's on primary homeowners, but the good thing about it is for us as real estate investors, there's still no cap. So whatever your mortgage interest expense is, that's always going to be a write-off against rental income.
Gotcha. Hey, so there's a lot of debate out there because I think it's been floated around in Congress that now's a good time to kill off the mortgage interest write-off. Do you see that as just kind of politicking, or do you see that as potentially having any steam behind it?
I think we're already seeing that in action. I don't think that they would get rid of it completely. But with the phase out, right, if you make over 250 or 300, they're already phasing out your home mortgage interest. So yes, indirectly, they have already started to take that away. The good news is that under the new rules, they can only take away up to 80% of your mortgage interest. Okay, so you can always deduct 20% of your mortgage interest, no matter how much money you make.
Okay, but previous to this adjustment, it was 100%, wasn't it?
Correct.
Wow. So they're taking away a significant amount of write-off. So for those higher net worth individuals, it's starting to make a lot more sense to pay in cash than it is to hold on and pay a note so that you can have those write-offs.
Potentially, that's correct.
But that's only for your primary residence, or is that for anybody's rental? Even if they're rich, their rental property is still 100%.
Exactly. And the reason is because rental is kind of like a business, so they're not limiting the deduction for investors.
Well, that is a fascinating piece of information, and that changes my mind on buying that $10 million house I was looking
at. Me too, Josh. Me too.
Yeah.
Well, cool. Well, hey, let's move on a little bit to some tax planning stuff. What exactly is tax planning, and why do we need a plan for it?
Sure. I think a lot of people feel tax planning is something very scary and only very rich people do. Rich people like Josh do tax planning.
Can I open my books to you, Amanda? just to prove and demonstrate that, that's just wrong. I got 3 kids to feed.
Tax planning could be a very simple process. Really, it's about open communication with your tax advisor. What I always encourage people to do is to stay in touch with your tax advisor throughout the year, because we all know tax law is changing all the time. And it is hard for the average investor or average taxpayer to keep up to date on what all the changes are. And so from a planning perspective, you really just want to lean on your advisor, give them a call from time to time. For investors, whenever you're buying or selling a property or you're entering into a new or different kind of transaction, those are always great times to just call your advisor, because they will be able to tell you, hey, you're gonna do a lease option, you're gonna sell something via lease option. So, what are the things we should look out for? How should we structure this? Should we have an entity? So, from a taxpayer's perspective, it's really easy. It's really just about communication.
What do you think? At what stage in the real estate game should somebody actually go and talk to a tax advisor? I mean, I know from a CPA standpoint, you probably say always, but like if I'm brand new, I don't have any rental property yet, I want to get into the game. Should I talk to one before I get started? After I have 1 property, 10 properties? When does that make sense?
Mm-hmm. Yes, that's a great question. And my answer might surprise you. So no, I don't think everyone needs to have a tax strategist and have this overall plan and legal entities. But I do think it's a good idea that as you get started, even before you purchase your first property, to at least have a quick conversation with a CPA so you know what are some of the things you want to look out for based on your scenario. Before you close on your first property, that's definitely a good time to have a more in-depth conversation. So that's what I would say for, newbie investors. At least have a conversation. I mean, before you get started, you do want to interview a couple different advisors just to see, which one works with you, which one jives with your personality.
Okay. And where and how would I go and find somebody? Is there a specific certification that I'd be looking for? And in particular, I know there's a lot of tax advisors out there, but there's not a ton that are super savvy in the world of real estate, or is that not true?
Yeah, I think, asking fellow investors is a great place to start. Going to real estate clubs, and when you go, you'll know who are the people who are doing the deals, who are active in investment. Ask them who they're using. most likely they're using someone who is well-versed in real estate. From a designation perspective, if you can work with the CPA, that's always the best because they're the ones with the highest level of training. I would just stay away from a lot of the franchise type of tax prep shops. And the only reason is because a lot of times you're working with people who are just coming out of college or maybe didn't even go to college. So, from that respect, maybe you might as well just, do the research and do the tax returns yourself.
Yeah. Is that, and that's probably a pretty good point. I mean, you're talking, we're not going to name names, but there are people who will come out without degrees working at these places who are doing preparation, and it's something to be cautious of.
Yeah, and I think when you're interviewing CPAs, it's also important just to make sure they understand your business, make sure they understand your lingo. So if you're talking about depreciation or if you're talking about lease options, hopefully that's something they already understand so that you don't have to be the one educating them on what those are.
Well, and I think if you're educating your CPA or your accountant or tax advisor on what a lease option is, it's probably time to find a new one.
Yeah. Hey, how important do you think it is that your CPA invests in real estate as well? I know a lot of people say that's a good idea to find someone. Is that vital or is that just a good idea?
For me, I feel like it is very important because I do have clients who have good CPAs, but their CPAs will advise against real estate investing. Mm-hmm. Maybe because they're CPA/financial advisors who want to direct you towards the stock market, or maybe they personally just don't like real estate. So, I don't think it's the end of the world that they don't, but I think it's very, very helpful if they also invest in real estate as well.
Okay. All right, cool.
That's great. You had mentioned earlier entities and mm-hmm. We didn't have it in our notes to cover this, but I think it's an important topic. Can you tell us a little bit about that? You're talking about me not purchasing a property as Joshua Dorkin, correct? You're talking about creating a company, an LLC, an S corp, a C corp, something like that, and purchasing either one property in that entity or purchasing multiple properties in that entity. Is that right?
Correct. And I'm glad you're asking me about entities because that's probably one of the most common questions that I get asked when I speak, whether presenting or talking to clients. So I know you're going to hate me, but the answer really is it depends. Yep. But I'll give you a little bit more than
Amanda,
that.
make a decision here. Okay, we want real answers. This. You are not running for Congress. You need to answer the. No, just kidding.
So what it depends on is it depends first and foremost on what you're doing in real estate, right? Because we don't want to make the assumption that everyone's doing rental real estate. Yeah. So if you're doing rental real estate, the tip here is that from an entity perspective, okay, it really makes no difference on your taxes. Okay, as a rental real estate investor, you get the same deductions, the same depreciation, the same write-offs, whether you hold that piece of property in an LLC or if you hold it in your personal name. And so a lot of times when you hear people talk about, you must have your rental in an LLC, generally what they're referring to is the asset protection side of things. And I'm not an asset protection attorney, so I won't tell you all my crazy thoughts about that.
Oh, we want to hear them. No.
Gosh, I don't even know if I can say stuff like this on the show.
Let's upfront it with Amanda is not giving any legal advice, and of course you need to speak to an attorney about anything and everything that you hear on this and frankly all our shows. If you're going to make any decisions in real estate, you definitely want to seek the advice of counsel before going forward. So.
Okay, I like that. So for me, whenever I look at entity for rental real estate, from an asset protection perspective, I'm always looking at the cost benefit. So for example, if I have a client who has, not a lot of assets personally, just starting out in real estate, they have really no equity in the property. then it might be okay for them to actually hold that property in their personal name. Why? Because they have no equity and they have no assets that they're concerned with.
Right.
On the other hand, if it's someone with a lot of net worth, then yes, I would highly suggest an entity. What I hate is a lot of times I have clients that come to me after they formed 5 different LLCs, and the LLCs are set up to do such and such, and this one is set up to do such and such, but they're not really doing anything. And the reason I don't like that is because they've incurred a lot of costs to form them, first of all. And then they're going to have to pay me a lot of money because the entities have to file tax returns.
Right.
And if they're lucky or unlucky enough to be in California, the state wants $800 per entity.
No matter what, if you don't even make $1, you got to pay $800. Yep.
Exactly. If you make even if you lose money, you still got to pay them.
Yep. Yeah. No, I think it's important to hear. I mean, again, Amanda's not giving legal advice on what you should do, but she's just kind of talking about, her take, her opinion on it, just to clarify and CYA, so to speak. But yeah, I mean, I think a lot of people will kind of assume that you have to do it, and I think the main reason that asset protection attorneys will tell you to do that is primarily, to protect yourself if you've got money. And
yeah, like I said, I think the biggest misconception is people feel that I have rental properties, but it's not in an LLC, so I might have gone to a real estate conference. Oh, but I can't deduct it because I don't have an LLC. And that's absolutely incorrect. As long as you have an expense related to your rental, you could deduct it regardless of what funds you paid that expense with.
Yeah.
So, however, so on the other end of the spectrum, if you're someone who is active in real estate, meaning you're wholesaling or you're flipping or you're syndicating, you're doing money raising stuff, then entity does have a tax impact. So from a tax side, I do strategize with people on what that is.
So can you explain that? Because there is an actual distinction between somebody who's active in real estate and somebody who is not active in real estate. And what does that mean exactly?
Sure. So when someone is a rental real estate investor, you are never subject to self-employment taxes. Okay. On the other hand, if you're someone who is active in real estate, wholesale, flipping, raising money, that type of income is subject to self-employment tax. And the easiest way to look at it is, for people who make W-2 income, right? We have our money coming from our paycheck, and then as part of the paycheck, part of that money is taken out in payroll taxes. So payroll and self-employment taxes are essentially one and the same. The reason there's a difference is because the IRS, again, just penalizes people who actually work for a living. So they're saying if you're actively involved, if you're on the short term buying, selling, wholesale, that type of stuff, then not only are you going to pay income taxes, but you're also going to pay self-employment taxes on that income.
Gotcha. Hold on a second. I need to wake up Brandon. He fell asleep there.
No, I'm here. This is fascinating because yeah.
There he is.
I'm here. I just I mute my mic so my cats that tend to walk across my keyboard don't make noises.
Isn't there's also something to do with active real estate for somebody who spends X amount of their time doing real estate? What's that all about?
Yes, I think what you're referring to is active real estate with respect to rentals.
Yeah.
And
the management of the rentals. Yeah, that's what it was.
Correct. So, again, going back, rental real estate is never subject to self-employment taxes. Okay. So if you spend 700 hours or 10,000 hours on real estate, you would still never be subject to the self-employment taxes. And so from that perspective, this is what I was talking about earlier. It doesn't matter whether you have a legal entity or no legal entity. Now, when you're flipping real estate, for example, that money is generally always going to be subject to self-employment tax. So typically, from an entity structuring perspective, we recommend that you flip inside of an entity, such as an S corporation or a C corporation, so that you don't have to, so that it minimizes the self-employment taxes that you pay.
Just so our listeners can tell, Brandon has called his cat over.
I did not call it.
to now sit on his lap, distracting both Amanda and I.
I did not call it over. It just, he saw that I was warm and
Lonely.
and decided to come and hang out. So
he saw that you were falling asleep.
Yeah.
Yeah.
Oh, he's gone. See what I mean?
But okay, so no, that makes a lot of sense. But in terms of management, there are specific tax implications of being an active participant in the management of your property versus not being active. Is that correct?
Potentially, kind of depends on your income. So, the IRS has this quirky little rule that says, okay, if you're someone who's doing rental real estate, and you have depreciation, you have all these write-offs. But if you're someone with higher income, then you don't get to use those losses to offset your other income, like W-2, for example. But the way around that is that you show them that you're actively involved in managing your real estate. And that's typically referred to as real estate professional status.
Yep.
Does that mean you're the one out there plunging toilets and getting cats from underneath the house?
Not necessarily. Real estate professional just means that you have to be spending more time in real estate than you do at your other jobs or businesses. Okay, so if you're someone, let's say you're a part-time teacher, and you teach 20 hours, or let's say you teach 2,000 hours a year. Well, that means you have to be spending at least $2,000 in your real estate activities, not necessarily plunging toilets. You could be taking classes or looking for properties, but you do have to be spending more time in real estate than being a teacher.
Well, what about this then? I'm getting specific because I can, because I'm the co-host here. So
wait, clearly Brandon is about to take advantage.
I have taken advantage of this.
A free tax strategy.
Yeah, here we go.
Man.
Well, here's what I'm wondering: a person who has a job like me, who's working for BiggerPockets 40 hours a week. My wife works full time on the rental properties. She works, full time. So do we claim that or not?
Yes, you can, because as a married couple, that's very common that one spouse is working maybe full time, the other person does the real estate. So yes, in your example, if your wife's not doing anything else, she's spending at least 750 hours for the whole year on your real estate, then she can qualify as real estate professional. And the best part about that is now you guys collectively can use all the real estate losses to offset your income from your W-2.
Nice. See, that was a good question. I bet there's lots of people out there.
It was. And just so you know, you will be billed, let's see, that was about 4 minutes and 4 minutes. Amanda charges $1,000 an hour. So yeah. Okay. $40. I don't know. I didn't do the math.
Wow.
No, that's great.
Yeah, that's good to know. Okay. So let's, I don't know, let's move on a little bit to, because I know this could be like the longest show we've ever done, so we don't want it to be the longest show ever. Why don't we move on to...
I would like it to be the longest show ever. I think Amanda is fantastic. What are you saying?
I think so too.
I agree. Well, what I want to know is we are, like, for those listening live right now, or, the day this comes out, the few days afterwards, we are at the very, very, very tail end of 2013. So I'm wondering, are there any... We talked about things changing, and there were some things that happened at the beginning of the year. We've got a week or two left. Is there anything we need to be doing right now for those listening, or anything we should be concerned about taxes this year?
Yeah. Well, couple tips. So this is the last year of bonus depreciation. We talked a little bit about depreciation earlier. So this year, if you bought new assets for your business, for example, you bought a new large SUV, let's say, that you're using for your business.
Must be nice, Brandon.
I don't have an SUV.
This is the last year that you could write off up to 50% of that purchase price, all in 1 year.
Wow. Does that count for rental houses? I'm assuming.
You're just talking equipment, right?
Yes, yes, not the property itself. So if you bought a house, you can't write off 50% of it. But if you bought a computer or you bought new trucks, SUVs, appliances for your rentals, okay, all these, so the caveat is it has to be brand new. So if you're a slumlord and you're buying used refrigerators, that does not apply. It has to be brand new.
I buy used, but I am not a okay, maybe I am.
Yeah, and I'll stand up for other landlords out there. just because you buy used equipment doesn't mean you're a slumlord.
Thank you, Josh.
Yes.
Thank you.
Yeah. No, but that's great. That's really interesting. So essentially, we've got 2 weeks left to spend some cash, is what you're saying.
Spend some cash, exactly. And then also, from a year-end perspective, outside of depreciation, if you're someone who does a lot of marketing, or just I would look at ahead in January 2014. What are some major expenses you think you're going to incur if you're going to redesign your website, for example? It could make sense for you to charge that expense on your card before the end of the year. That way, you're just prepaying for that by a week or two, but you accelerate that deduction for one entire year.
Yeah. No, that's good advice. That's very good advice. Time to figure out how to spend this money. Well, so that's really useful. Well, let's talk about mistakes, because I think it's really easy to go ahead and make lots of mistakes in terms of taxes, because frankly, I don't think anyone on the planet has actually read our entire tax code all the way through, despite what Amanda wants to tell you. So what are some common tax mistakes that you see investors make?
Sure. I think the most common one that I see is probably just not claiming legitimate deductions. Real estate investors, what a lot of us do is, we're really good at claiming mortgage interest and property taxes and, insurance, right? That's no-brainers.
Yep.
But a lot of people aren't claiming car expenses. So when, if they drive to a property that they already own, or driving to new properties, or even driving to local real estate clubs, a lot of that is missed. Or, what you pay for membership dues to local RIA groups.
Or websites like BiggerPockets.
Oh, yes, exactly. That's also tax deductible in case anyone wanted to prepay that right now for the next 10 years.
That's a really good idea, Amanda. I strongly advise anyone to go to biggerpockets.com/pro and sign up a year in advance. That's a great idea.
That is a great idea.
Gosh, I don't even know what I was talking about now.
Oh man, we were talking about mistakes.
Mistakes. Okay. Yeah. So just making sure that you understand what are all the tax deductible items. If you're unsure, always ask your tax advisor, how can I deduct that? So Brandon, he has a cat, for example, right? How can I deduct my cat food? Well, it might not be possible, but if your cat is your security at a place that you're rehabbing, for example, right? So maybe some of those expenses could be tax deductible.
So can you get a write-off on most cities don't allow pit bulls, but can you get a write-off on like a Doberman if you have a pet Doberman and put him in all your houses?
Yeah, that's happened. That's happened in the past before, actually. There's been court cases where people were able to deduct pet food if their pets were used in their business. There was actually a court case where someone was able to deduct money that he paid to his girlfriend. And what happened was this guy was...
Wait, why is he paying money to his girlfriend?
Well, you're getting ahead of me there.
Is that girlfriend in quotation marks?
So
she did live in Vegas, Brandon.
Yes. What happened was, there was a guy, it was a real estate investor actually, and this went all the way up to the tax court. So real estate guy paid his girlfriend, took a write-off for it. At the end of the day, he was allowed to take the deduction because he paid his girlfriend to stay at one of the properties he was rehabbing, because there was a lot of, thefts and stuff. So he paid her to actually stay. I don't know where it was. Maybe it was in the ghetto, but she stayed there, and he paid her for it, and he was able to get a tax deduction. So I think that's similar to your scenario, Josh, about a Doberman, but that might be better than sending your girlfriend there.
Yeah, I don't know. If I want to send my girlfriend, unless she's like a 3rd-degree black belt, to sit on a rehabbed property to protect it.
Yeah.
And my wife would be really pissed if I were paying my girlfriend.
Yes, your wife would be upset. I just want to acknowledge, Josh, that you had the total opportunity to throw in a Detroit, make fun of Detroit moment there, and you didn't. So you're growing. You're maturing. This is good.
Wait, I thought I heard something. I'm sorry. We're trying to keep a professional interview going here.
Yeah, I'm sure we are. All right. Anyway, so mistakes. We talked about those. You got any other good ones for us?
Gosh, other good ones that not necessarily made by the taxpayer, but believe it or not, I see it quite a bit when people actually don't take depreciation expense. So that's something, and that's more just a result of not working with a tax advisor who works with investors. But the easiest thing to do, what I always tell people is to, pull out your tax return from last year. On the Schedule E, there's a line specifically called depreciation, and there should be numbers on there for every property that you own. If you don't see a number there, obviously time to move your books to someone else.
Yeah.
Another mistake was the real estate professional. We talked a little bit earlier. Brandon, in your example, we have a lot of people who, maybe the husband or wife is working full-time and doing real estate full-time, right? So then neither of them is qualifying for real estate professionals. So that's a mistake that could easily be fixed by, just delegating, by splitting the job so that one of you is doing real estate, the other one is working at the full-time job.
Gotcha.
Yeah, that makes sense.
Yeah, no, definitely. So, it's interesting because there are so many little things that you can write off in your business, and I think people aren't aware of it. I used to be in the entertainment business. I used to live in SoCal, and
whenever you say that, I always think like you were a stripper.
God forbid I was a stripper. Nobody wants to see that business.
Anyway, entertainment business. You were in there.
No, but I mean, you can deduct haircuts. I mean, you could. It's because your livelihood is what you look like. For example, us. If you and I, part of our business now is podcasting, right? This is part of our business. So anything to do with our throats. I mean, writing off lozenges and that kind of stuff. I mean that. I know it's minutia, but these are all little things that have to do with how we run our business, and those are acceptable write-offs, correct?
Correct. Mm-hmm.
Yep.
Cool.
Interesting. All right. So, next on the list here, and Brandon's got this written down, and I'll let him ask because I think it's an appropriate question for him.
It's not an appropriate question for me. All right. So I don't have kids, but I hear they're expensive. That's what the rumor is. My cats are expensive, and now I learned how I can deduct their cat food. So I'm going to go have my cats stay at my rental property. But so if you have kids, those investors out there with kids, how can we get a tax deduction for the money that we spend on those kids if they're, human kids, not cat kids? How do we spend them? How do we get the tax deduction for that?
Or is that even relevant at all to real estate?
Yeah, no, it's definitely very relevant. Earlier I was talking to you guys about how I used to help my grandparents paint their vacant properties, right? And so my grandparents would pay me for the work that I was doing. And essentially that's how you take a tax deduction. Instead of, let's say you had two teenage boys, instead of just giving them money for them to buy a car and take girls out on dates, what you can do is you can have them come help you out in your business, help you paint, help you, do door knocking, hang posters, anything that's business related. If they're helping you out in the business, you can pay them a reasonable salary, and the amount of money you pay them becomes a tax deduction for you because that's a legitimate business expense.
Now, is that not like violation of every child labor law? If my 3-year-old was painting my rental houses, I mean, wouldn't I get in trouble?
So you'll have to figure out, from the EDD. Well, that's what it is for California, EDD, on what the restrictions are. Typically, every state will have requirements on, how many hours a child can work if they're under the age of 10 or 12 or something like that. But you were in the entertainment industry, like you said, so you've seen babies who are part of diaper commercials, or they're in the movies, right?
I suppose that's true.
Yeah.
Oh, she got you, Josh. Burn.
Oh man, I got burned. Well, I'm putting my 3-year-old, my 5-month-old to work, baby. Get painting, kids.
You do have cute kids. They could make it in the entertainment industry.
We're talking about real estate here, but let's screw our heads on, folks.
Before you put your kids to work, okay, the IRS does have their own restrictions or their requirements, and it's not necessarily age related. But what they do want is that what you're hiring them to do is appropriate for their age, first of all. Okay, and what you pay them is reasonable for what it is they're doing. So your 5-month-old probably cannot be your IT guy. You probably can't pay her $10,000 unless if,
She's pretty good with a hammer. She might do better than some of the contractors I've hired.
Yeah. So essentially those are the requirements. It's something that is reasonable for their age, and then what you're paying them is something reasonable for the market. So if you weren't going to pay your son to paint for you and you were paying someone else, maybe you pay that person $500 or $1,000, and then that's what you would pay your kid.
Interesting. It's fascinating, and that's a whole explanation why our tax code's so screwed up. Well, that's a whole long discussion. All right, so let's move on to a topic that's pretty popular. It's self-directed investing.
Okay.
Can we start first with what is a self-directed IRA?
Sure. Self-directed IRA is just like any other IRA that you owe, like in the past, most people will go to their local bank or financial planner and open up an IRA. The only difference with the self-directed IRA is you can use that to invest in real estate, notes, all sorts of assets, as compared to the regular IRA. The banks will give you 5 or 6 different options of mutual funds or stocks or CDs. So that's really the only difference. All the rules are the same. The contribution amounts are the same. The only difference is that you have more investment choices because you get to choose what you want to invest in.
And what are those limits on the IRA?
For this year, it's the maximum is $5,500 for a regular IRA contribution.
All right, so how does that help me or maybe it doesn't help me if I don't have an IRA? If I wanted to use, I can't just go put $50,000 into an IRA and then go buy a rental house with that. Correct? That's out of the picture.
It depends, which is your least favorite answer.
Where's my bill? I want to get my giant cane and get her off stage.
What?
So for this year, it is possible for some taxpayers to put $50,000 or more into a retirement account.
Oh, really?
And use that for self-directed investing. It depends on how much income you have and what type of income that is. Okay, so to give you an example, if I was someone who's doing fix and flip real estate, and I had $100,000 profit, let's say, or $200,000 profit, then it is possible for me, instead of paying taxes on $200,000, it's possible for me to put maybe $50,000 of that into a retirement account, get a deduction, and then use that $50,000 self-directed to buy a rental property.
Is it? You say it's a certain income level. Does that mean you got to be a lower income or a higher income to get that?
It's a higher income because how much you can put into a retirement account is a calculation based on that income.
Okay.
So, everyone knows about the IRA, right? So we can put $5,500 in it. There are other retirement accounts like self-directed 401ks or self-directed SEP IRAs. Those are the more advanced accounts where you can put in, 30, 40, 50,000 per year.
Oh, okay. So it is possible. There are ways that a person they don't have to wait 10, 15 years in order to have enough money because that's always what I used to think. I was like, well, if I can only put $5,000 a year and I'm going to be
what can you do with it?
Yeah, I'm going to be 150 before I can buy anything with my money. But there are answers to that if you have a qualified professional telling you what to do, correct?
Correct.
Okay.
Yeah. So, right now, I don't know if you have a 401k at work, let's say, you can put $17,500 this year into your 401k.
Yeah. Where's my 401k? Come on.
That's a good question. Where's mine?
Oh, that's right.
Yes. So if you had a good boss and he gave you a 401k.
Oh my God. Holy cow.
Yes.
Can we find another guest?
I know. I don't think I'm
The
coming back.
CPA is throwing jabs.
I'm going out hiring.
I love it.
So if so let's say not you, Brandon, but let's say there's a listener on the call who had a 401k with their work and they put in $17,500. Well, they potentially could move that money into a self-directed account and use that for real estate investing, right? And
Okay.
then next year, maybe they put another 17.5 and move it over to a self-directed. So it is possible to do that in less than 100 years or whatever you said earlier.
Okay.
Yeah, I had the
awesome.
same question as Brandon. I think it's actually probably the best question he's ever asked on the show. But
I
yeah.
don't think so. I got better ones.
Yeah. All right. Great. You're done. So what we talked about mistakes for tax purposes. What about common mistakes you see people make with respect to self-directed IRA investing?
Common mistakes for self-directed investing. Gosh, I think the biggest one is sometimes I see people take money out of their retirement account to invest instead of going the self-directed route. Guys, every year I probably have a handful of these people who talk to either their CPA or their financial advisor, and they say, hey, I'm going to get into real estate. I have a bunch of retirement money. I want to move it over to real estate. And they say, oh, no, the only way to do it is to take out your retirement account as a distribution, pay taxes, penalties, and then invest in real estate. So I say that's probably the biggest mistake, is people not even knowing they can do it. The tip is, if you have an IRA or a 401k and you want to move it to a self-directed arena, what I recommend is just doing a direct custodian to custodian transfer. Meaning, if the money right now is with Fidelity, you have Fidelity transfer it directly into a self-directed custodian so that the money never touches your hands. And that way you don't have to worry about potentially making a mistake and then having to pay taxes on that.
Okay. And in terms of those custodians, so you can't open a self-directed just at any brokerage, correct? I mean, there are firms that are specific to that, like Entrust, Equity Trust, and on and on and on, correct?
That is correct. So what happens a lot is, if you have Fidelity, for example, and you go and you say, I want to open a self-directed account, and they're going to say, yeah, sure, we'll open one for you. However, here are the 10 options you can invest in. So that's still not a truly self-directed. If you want real estate or notes or something other than something other than the stock market, it does have to be one of these special custodians.
Gotcha.
Okay. Hey, could I just jump in and ask a real basic question for those who are brand new to this stuff? What's the benefit of a self-directed IRA? I mean, why would we even want to do that?
That's a great question.
That is.
Thank you. Look, I'm full of
shocked.
questions today.
Oh my God.
Man, this is
two reasons for self-directed IRA. One is if you're someone who's brand new to real estate and you want to buy a property, but you just don't have any money. You don't have cash, right? But all of your money is tied up in a retirement account that you've been putting money into for several years. So that's one reason why you want to use self-directed investing. It's cash that you can use for real estate. The other reason really is just looking at return on investment. So if you're someone who's got some money accumulated in a retirement account and it's earning, 2% in a CD or 5% in the stock market, but you can generate a higher return by putting into real estate, that's the reason why you want to self-direct that.
That's right. That's
Cool.
great. I didn't know CDs actually turn out 2% these days. I thought it was still like, 0.5%.
You're probably right.
Yeah. All right. And before we move to the next section here, do you have any best practices you suggest with respect to self-directed investing?
Best practice, I would say the main thing, I guess the number one tip I would say would be, if you know that you want to do self-directed investing, move your money over and open the account first. What a lot of people tend to do is they'll keep their money with Fidelity, and then they're going to look for properties. And then one day they're going to find that perfect property or the perfect deal. But they forget that it's going to take anywhere from a week to a few weeks to move that money over. And by the time the money's over, the deal is gone.
Yeah.
Once you make that decision, I do want to go the self-directed route. I no longer want my money in the stock market. Then it's time to move the money over so it's parked and ready for you to deploy.
Gotcha. I've got a question. This is not a personal, but this is a question a friend of mine is dealing with. Since Brandon got to ask a question, I know somebody who's got a property that the property is partially their home and partially a business. And can you actually 1031 a property like that, or how would that work?
Yes, you can. So is this like a duplex that you're
No,
talking
for
about?
example, well, I guess that's probably something similar. If it were like a house on a ranch, and the ranch is the business and the house is the house, obviously.
Mhm. Yeah, you can. You definitely can 1031 exchange. The thing that I would, encourage you to look at is, as a primary home, if you're someone who's married, you do get up to $500,000 of tax-free gain already,
Yeah.
right? So if you do a 1031 exchange, you are potentially losing out on that tax-free gain. So that's
Gotcha.
just something to strategize on. But yes, that is possible.
No, that's good. I just, I felt like Brandon asked a personal question, and I thought it might be appropriate that I get, my 4 minutes of free counsel.
No, but I actually think, Josh, you touched on something really good. We need to is every real estate investor works from home. I mean, like they might have a job as well, but they obviously have their base of operation at some point in their house. So let's talk about the home office deduction. How does that? What is that? How does that work? And should we even claim it? Is that just a red flag?
Another good question.
I'm on fire.
Yes.
On fire. Fire.
Home office deduction is actually, like you said, most real estate investors actually have one. A lot of times I see people not claiming it. And the reason is because of the scare tactics, right? Maybe the old CPA said, oh, it's a red flag, it's super scary. But in fact, one of the changes that came out this year is the IRS is actually making it easier for people to claim the home office deduction. So they're doing it where, in our car, like for car expenses, you can do a standard mileage deduction. You now have that option with the home office too. So instead of keeping receipts for all of your, electricity bills and that, phone bills and all that, you could potentially take a standard deduction from the home office.
Oh.
In terms of who qualifies, essentially two things. That space has to be exclusively used for the business, meaning you can't also have your baby's nursery be, right there. You can't be working from the nursery. Your office can't also happen to be your dining room, kitchen table. Okay.
Yeah, you need a dedicated space, right?
Exactly, dedicated space. And the other requirement is that it has to be the place where primarily your business is run. So, a common example would be, a realtor. Okay. A lot of times realtors work from their office. That's where they make offers. They look at properties and stuff like that. But they also go to the broker's office because there's like a temporary hoteling cube that they can go to, or they maybe use the conference room, for example, at the broker's office, right? So that's an example of where home office works, because even though you go somewhere else to meet with clients, but your home is where you do most of your actual work, that allows you to claim the home office deduction.
Fabulous.
Yeah.
It is fabulous. Amanda, I wish we had more time. I really do. We didn't talk about 1031s. We didn't talk about a lot of things that I wanted to, but we've got to move on. We've got to. And what's going to happen is Amanda is going to keep writing amazing content on BiggerPockets, and you could learn all sorts of great information from her there. And with that, I think it's time to move to the fire round.
It's time for the fire round.
Oh, scary.
Well, all right. These questions all come directly from the BiggerPockets forum. These are all actually from the tax forum. So let's just go with number one here. Are business/real estate books tax deductible? And then the second half of that question is, what about guru boot camps? If you go to some, $20,000 weekend boot camp, are those all tax deductible?
Yes, they're definitely tax deductible.
No,
They better be.
cool. I know.
It's about the only value you'll get out of it.
What about a cruise? What about an investor cruise? Like if the BP Summit was at sea or something, that would be cool. But.
Yes, that's a little bit tricky, and that's the short answer is generally the cruises are not deductible. And that's just a loophole that they have about cruises being on international waters and why that's not deductible.
Really? Wow.
Yeah. So if you guys are planning a cruise,
We're not.
Man, that cruise
Maybe
industry
do.
lobby needs to get on the IRS.
yeah. Exactly. Yes.
All right.
Okay. Well, no cruise for the BiggerPockets next summit, but that's all right. I'm still going on one in February. I'm just not deducting it.
I'm going in January.
Nice.
Oh, must be nice.
Yeah.
I'm going
Hey, Josh.
nowhere.
Yeah. What is yours? Oh, that's right. You have kids and a business.
Wow. I like you less and less every day.
Good.
So, Amanda, next question. Should a real estate investor have a health savings account?
Yes, generally I would say yes. If they qualify, if they have a high deductible insurance, why not? I love the HSA because it's one of the only things in the world that gives you a tax deduction when you put money in. It grows tax free and the money comes out tax free. And more importantly, you can use that money into real estate. There's self-directed HSAs as well.
I've heard that. That's
no
fascinating.
Interesting.
Is there a limit on how much you can put into an HSA?
Yes, I think it's a little bit over 3,000 this year for single, and then a little over, I think it's about 6,200 for family coverage.
Oh, so you can actually use this to buy Detroit property.
There you go, Josh. You got it in there.
You could, all cash.
Yeah, wow.
Cash.
Hey,
I mean, because obviously you can't do squat in Los Angeles.
Yeah, you can't. Well, what about this then? Could you, this is going to be my next fire round question, even though I didn't have it pre-written. All right, a wholesaler, if they were to take $1,000 from their HSA or their self-directed IRA, and then they were to use it as a earnest money on a property, and then they were to flip that contract to another buyer and they were to make 10 grand on it. Is that that 10 grand tax free?
Correct.
Wow.
It is tax free.
So a wholesaler has a really large incentive for having a tax planning strategy.
Yeah, exactly.
Awesome.
Ooh, that's pretty nice. That's pretty nice. All right, I've got one. A tenant completely trashed my unit. Been there, done that. And now it needs a total rehab. Can I count the entire project as a repair, or do I have to expense it?
I think my answer is going to be an unpopular one. It's going to be it depends. It depends on what are the items that are being fixed. So, maybe the fact that they trashed the toilet, the appliances, you have to redo all that. That would be repairs expense. If as part of that you have to redo drywall and all those, those kinds of things, that would still be an improvement, unfortunately.
Interesting. Fascinating. Okay. All the more reason to talk to your accounting professional, isn't it?
Yes. Very good. All right, next question. Can I deduct the cost of an iPad if I plan on using it at least in part for business, but I'm sure I will also play some Angry Birds with it?
Oh gosh, my answer depends on if the IRS is listening to this show or not. So IRS, if you're listening, no, it's not deductible. It has to be 100% business use. But I think though in reality, most people are using our devices majority for business. Maybe sometimes if you happen to play Angry Bird on it, which I highly recommend against, but if you happen to, I think that's immaterial enough, you can probably get away with it.
Okay. Fascinating. All right. Last question here. Amanda, I need help. Amanda?
Yes.
Yeah. Hi. Amanda's falling asleep on her own interview. Amanda, I need help. I'm getting audited from the IRS. What do I do first?
Well, that's a good question. And in fact, we've seen audits on the rise. My not for our clients, fortunately, we really haven't had that many. But my uncle, who's also a CPA, he said that he's seen tons of audits, and in fact, he was thinking of changing his business so that he specializes in dealing with audits. So if you get audited, I really, the first thing is don't freak out, right? Just take a deep breath. And then my suggestion is to send that notice to your tax advisor, okay? Whoever prepared that return. You might have changed CPAs from that time because, you might be being audited for like a few years ago, but send it to the person who prepared it first. And see, if they include audit protection as part of their fees, or, if there's going to be any additional fees for that. It's generally better to have someone represent you because there's a buffer point. Yeah. Okay, so what happens is if my client got audited and they said, what is this $30,000 expense? Or give me your documentation for your real estate hours. Well, now I have time. I can say, oh, well, let me find a client and ask, so now that buys you a week to put this stuff together. If you represent yourself, you're sitting across from the agent, you kind of have to just, show them what you have.
Gotcha.
Good tip. All right. Yeah, good fire round. Good fire round.
But anyway, all right. So fire round, that was great. Lots of good stuff. I think it's time to move this forward and move on to the
All right. Famous four. These are the same questions we ask every guest, and I like these questions. So number one, what is your favorite real estate book?
Oh gosh, I have to say Rich Dad Poor Dad because that was my first. I don't know if that's necessarily real estate specific, but
It's good.
I know.
It's my choice too. So
There you go. All right, fabulous. All right, Amanda, your favorite business book, and no, you cannot cite the IRS code.
I really liked the 4-Hour Work Week
yes.
Okay.
because I'm a very lazy person. I like to work as far as possible.
I'm glad to hear that about the person I was about to hire as my accountant.
But it's about working smarter, right?
Oh, yes. Yes. All right.
There you go.
That's a very popular book amongst our guests. What about hobbies? Surely it's not all number crunching for you. Do you do anything exciting out there in the land of sunny California?
Yes, I'm afraid I'm gonna have to bore you guys on this one. My favorite hobby is actually eating. I love eating. I'm a
Nice.
foodie. I love going to all types of restaurants and hole in the
Nice.
walls.
Nice.
Yelp stuff.
Yeah. Wait, where do you live in Southern California?
In Orange County in Fullerton.
Okay.
Yeah.
Gotcha. Yeah, I'm a foodie too, and I love going to restaurants in SoCal when I get out there, and so that's awesome. Foodies unite.
I just like pizza. I just want pizza. Is that sort of bad?
Pizza.
All right. Final question of the famous four. From a tax standpoint, what do you believe sets apart the real estate investors who succeed and do great from those who don't, and they maybe, I don't know, fail, give up, whatever?
So when you say from a tax standpoint, you mean like good at saving taxes?
Yeah, maybe
Like-
mostly they ask this question always like, what do you see successful investors do differently? But I kind of want to get your take on what do you see from a tax standpoint? Those who save the most taxes or have the best luck with taxes or whatever you want to call it.
I mean, the people who scam the system the best. Is that what you're trying to say?
the people who play the system the best, not scamming. Like, what's the difference between them and everyone else?
Got it. Okay.
They pay Amanda cash under the desk is probably answer number one.
I think, even within the tax world, I think the most successful real estate investors are the ones who actually implement. So, for example, we do a lot of tax planning with our clients. So we come up with strategies and ideas, but it's only as helpful as your willingness to actually implement. So if we're talking about opening entities or setting up retirement accounts, simplistically just following directions, right? If your advisor tells you to do something, you do it, and then you see the results of tax saving. So I think that would be my answer to your question.
Good
Okay,
answer.
I like it.
It's a good answer. Amanda, I got to tell you, you've been a great sport.
Yes.
No, seriously, you've put up with Brandon's abuse throughout the show. And you've answered concisely and definitively in every question asked of you. Never waffling or wavering, never giving it depends. And we appreciate that.
Thank you so much for having me on the show.
Hey, honestly, it's been a real pleasure. We've really enjoyed it. And to be frank, I was a little nervous. I said to Brandon yesterday, I was like, Brandon, we're doing a show on taxes. This is going to be incredibly boring. And I've been at the edge of my seat the whole time. So it's really good stuff.
Thank you. Thank you.
Thank you, Amanda. We'll see you on the site.
All right, everybody. That was Amanda Han, the CPA from hell.
Clearly.
No, Amanda's awesome. We love her. She, if you guys haven't checked out her stuff on the BiggerPockets blog, definitely do that. We really, really want to thank her for the time. And as we talked about up top, definitely check her out on the show notes at biggerpockets.com/show49. But as we said earlier, don't get into your whole story and ask her for free advice. If you've got questions about anything we talked about, fabulous. But, you're going to have to hire a CPA, guys, if you want that financial feedback. Otherwise, thanks as always for listening. This is, we wanted to make sure to get this show in before the end of the year because there are some really good last minute tips in there. So hopefully you got those. That's it. Keep following us, keep engaging, and don't forget that quick tip about Gmail from the front of the show. And otherwise, jump on BiggerPockets if you're not doing it already. We love to have you. We'd love to see you participating and growing your network with us. So come on board. That's about it. I'm Josh Dorkin, signing off.
You're listening to BiggerPockets Radio, simplifying real estate for investors large and small. If you're here looking to learn about real estate investing without all the hype, you're in the right place. Be sure to join the millions of others who have benefited from BiggerPockets.com, your home for real estate investing online.
This is the BiggerPockets Podcast, show 49.